Hey, good afternoon for this 3-minute Thursday. And forgive the delay. We're a week late on this one. We did this intentionally because the market was capitulating pretty dramatically with the midterm elections. So we're going to dive in. There's a lot to cover in this one. We're going to try to keep it as short as possible. And we have a lot of news about the office and the company as well. So let's get going. First is let's look over the market performance for the last couple of weeks. And especially we're going to look at month to date here because the market moved so fast in the last couple of weeks. I want to make sure we cover that. So we finally had the move that we talked about with the midterm elections. As you can see, the overall market for the quarter to date, it's 10.4% for the S&P. The Dow Jones is 16.7%. Then you're looking at the world MSCI is 11.1 and the Europe index is 17.4 is the big winners here. The market is still down pretty dramatically. So emerging markets is still down negative 23%. The NASDAQ composite, which is the heavy tech, is still down negative 28.4% year to date. S&P overall market is down negative 17. So there's still a lot of room to run here. But we do think there is a top that we've hit. So we're going to be a little more cautious moving forward. We did participate very nicely inside of some of these gains, covered a good portion of our clients' portfolios of losses this year. The other thing that's really a concern going forward is that 3-month to 10-year, the inversion is still happening here. So we need to be cognitive of the overall credit market long term. So we're going to start moving a little more into long-term fixed income, but we're going to be very, very slow in that movement. So let's look at sector analysis. The big winner quarter to date is going to be energy for the quarter, still 28.9%. Energy did pull back, but it's starting to rally pretty good. And materials was up 19.2%. And then you're looking at financials up 16.2%. Big losers is the consumer discretionary was actually negative at negative 1%. Over the last month, though, you're looking at industrials at 4.7 was the big winner inside of there. Financials did well also at 4%. US dollar starting to weaken now. So this is what we've been very excited about, looking forward to that dollar weakening. It was at roughly around 114. And now it's at 106. It's down 4.4%. So that's really positive news. Euro's starting to gain steam here. It's up 5.5% quarter to date. Moving into U.S. rates and real GDP. So this is very important as GDP for the last quarter here is 0.6, so not even 1%. We're seeing that first quarter being negative. So we are not out of the woods, and I'll explain that here in a little bit. But the first couple of quarters into 2023, we could see those lows again for the last pullback until the market finally clears its throat. And then we could see a very, very bull market going into 2020, the fourth quarter of 2023 and 2024. So pretty good there. Central bank rates, we're going to see that continue to rise here, probably another 50 basis points over the next month or so. We'll talk about that here in a few minutes. So overview for this week, midterm elections, man, it was not the red wave we thought it was going to be. It looks like the Republicans will win the House, but they failed to secure the Senate. Splitness is not a bad thing for the market. As you can see, the market has rallied because of it. So it's a very thin margin in the House. So hopefully it's going to be enough to lock up the political environment where they're not to pass any problematic laws that's going to hinder the market. The Fed fund rate did raise by 0.75%. In November, that's what was expected. We do see the Fed pivoting a little bit and moving that to 0.5. We'll talk about that as well. Unemployment rates are higher at 3.7%. This is positive. The market's taken that as positive because it's another leading indicator that the inflation's going to actually continue to go down. So when unemployment goes up, we're going to see a softer inflation. So that might be a good thing. Markets did hit the target that we're anticipating, and we're going to talk a little bit about what we're going to do next. So a lot can be said about the outcome of the midterm elections, but the market has a very friendly result for us. The Republicans has taken the House right now. this was a day late, so I think the Republicans did secure 218 is what they needed. And I think they're going to end up at 218. The Senate is still under Democrat control, but it should have the majority effect of the market in the near to distant future, where they're not to be able to do anything with any crazy laws that are going forward. The Fed is expected to pivot from the 0.75% rate hikes to maybe in December 0.25 to 0.5 or 0.5%. I'm in the camp that's probably going to be 0.5%, and then we're going to see smaller rate hikes in 2023, which is really a positive thing. So hopefully they're going to start tapering these things down. It was at 0.75, now it's at 0.5, then 0.25 for a couple of quarters, and then we'll see that it's all going to be telltale sign on inflation. So despite the bear rate hikes, probability of a 0.25 to a 0.5 rate hike in December is already baked into the market. February rate cut, again, goes back to the 0.25% to 0.15 or 50 basis points. It's still very early, but we'll keep this in the back of our mind. But you can see that the changes in the target now is actually moved up a little bit from 29% of the Fed's probability is at 350 basis points to 375, or that's 3.5%, up to the 4. So everybody, about half the markets believing that the end of the rate hikes will be right around 4% for the Fed. About 80% probability of that's going to happen. Unemployment rate at 3.7%. The new polls continue to say it's slowing. It's not displaying robust growth, which is probably going to be there for a while. Let's see if we get through the holiday season. And once we understand holidays are there, hopefully we're going to get a little higher unemployment. We don't want to go crazy here and hit 5 or 6 or 7% unemployment. That's going to put us in a deep recession, but we would like to see about 4% unemployment. I believe, and this is my personal beliefs here, that once you see a 4% unemployment, that you're fully employed in the United States. When you start seeing it below 4% unemployment, then you're starting to see a lot higher pay from companies, which stifles growth a little bit. So it's a good, healthy to be around 3.5 to 4%. I like 4%. I think the market handles that a little bit better. So we're near our target risk zone. If you'll see over in the right-hand corner, that little green spot where it says 4,000 or 3,999.5. So our target expectations was 4,000 to 4,050. We're right there. We actually hit 4,030 a couple days ago. So we're right at the top of our zone. We think 4,100. Doesn't mean that it can't go higher. I want to be specific here. We could hit 4,200, right? We can't predict what the market's going to do. We just use probability studies to understand what the market could do and what's the highest probability. So right now we think that 4,100 is kind of the top, where our expectation was 4,050. So what happens after that is really where the question is. Key points and takeaways. So one, the market is in a risk zone. We've had some longs and we're going to sell them. So longs and shorts don't quite make sense right now. So we're just going to sell, hold a little bit of cash and go into a little bit of bonds, very short duration bonds, to kind of protect our gains here and let the market pull back. Unemployment's at 3.7. Job market continues to display weakness. I think that's a good thing. So we'll see how that fleshes out. Temporary transition into lower risk. We just got through talking about that, and looking for probability to set up to go long. That's going to be a good thing to have over the next couple of weeks. We are moving to a new office. This is actually going to be our last video in this office. We've loved this office, but we needed more space. We're hiring 2 new employees. We're finalizing our interview process right now, so the new space is perfect timing for us. So the new address is 6213 98th Street. We'll be just right off of 98th in Milwaukee. It's about double the size of where we're currently at. Very nice building. I'm very excited about it having everybody there. We're going to have an open house coming in December inside. So, everybody can have a nice little drink, some coffee, a cocktail, and sit and visit and get to know each other a little bit more. And especially around the holiday seasons, I think it's going to be great to have everybody around there. So we'll keep you posted on that. That's it. We've had a lot of new changes here. We feel like that we are comfortable where the portfolios are. We probably need to be cautious here going into the end of the year and starting next year, and we're going to look at that. So we don't need to make all of the gains back up in one day. We just need to be diligent and have a flight to safety, because we do believe the markets over the next 1 to 3 years are going to provide a very large amount of returns for our clients. We can never guarantee that, but we think we're going to be in a very good position whenever the market does go up. Here's a little bit of our disclosures, and if you would like to get together with us before the end of the year, especially for tax planning, give me a shout and let's get together one-on-one. Talk to you soon. Thanks. Bye.